All right, a couple sample problems we have here relating to materials covered in Chapter 2, and these are from your text. This exercise, the first ones we'll do here, exercise 2.7 and 2.8 from the end of Chapter 2. I will walk through these kind of quickly, try to explain what's going on here and how, at least when I do these, I think of them. So 2.7, the first thing it says is prepare journal entries, prepare general journal entries for the following transactions of a new company called Pose for Pics. Use the following partial chart of accounts: cash, office supplies, prepaid insurance, photography equipment, common stock, photography fees earned, and utilities expense. And then below here we have dates and the transactions in question. So we'll start here. We have August 1st. And in this case, Madison Harris, the owner, invested $6,500 cash and $33,500 of photography equipment in the company in exchange for common stock. Well, and again, thinking from the company's perspective, they received cash. We know cash as an asset has a normal balance on the debit. Let me switch this up here a little bit. So when we increase cash, we will debit that. And that was what, 65. And the company received $33,500 worth of photography equipment. So we have photography equipment for $33,500. Now, again, with accounting, we have to have debits and credits equal. So in this case, when we're thinking about this, and it tells us here they did this in exchange for common stock, so our credit, again, is going to be common stock for any amount of 40,000, because that's what we get when we add the 65 and the 33.5. And this is common stock on a credit because this is an increase to capital. And when we have an increased capital, we credit. So that's the first one. The next one here, and if I sound a little stuffy, I'm sorry, I've got some allergy issues going on this morning. August 2nd is our next one. The company paid $2,100 cash for an insurance policy covering the next 24 months. All right, so we paid something in advance, which means we own the rights to it, and in that case, that's an asset. So we're going to debit prepaid. Let's see, what is it they use? Prepaid insurance. They tell us what to use up here. So we're going to debit that for the $2,100, and then the company paid cash, so we will credit cash for $2,100. On August 5th, the company purchased office supplies for $880 in cash. From the company's perspective, they got, and it tells us by the accounts to use, we received office supplies in the amount of $880, and we paid cash for it, so cash being an asset decreases on the debit. So we will credit cash. Now on August 20th, the company received $3,331 cash in photography fees earned. So what do we get as the company? Well, we got cash. Cash asset. When it increases, we debit it. And we should know that when we increase or when we receive cash, it's increased in our perspective. And this is for photography fees earned. This is our revenue account. And revenue, remember, is part of equity. And when revenue increases, it is credited. Now, August 31st, our last entry, we're paying $675 cash for the utilities. So it tells us we have a utilities expense. Remember, whenever we see expense, we think kind of use, and we should think, well, yeah, we've used utilities. So we've got $675 here, and if we paid it, we're going to credit cash for the $675. So these are the journal transactions. So we've got exercise 2.7 is done there. Exercise 2.8, preparing T accounts. So we want to take the information that we used in this exercise and make T accounts. And I've already got some samples here of the T accounts. So when we make T accounts, all we have to do is look and think, okay, we've got a T account for cash. We want to look anywhere we used cash. If we have a debit, we'll debit it here. If we have a credit, we'll credit it here. And many times we'll see a date on these T accounts. I'm not going to put dates in, but for example here, August 1st, the company had a debit of $6,500 in cash. So we will have $6,500 on the debit side of our T account, and you may see a date out here to the side or a reference to the transaction. August 2nd, we had a credit to cash for $2,100. We'll credit our T account. August 5th, we had a credit for $880. August 20th, we had a debit for $33.31. I'm going to fix my T account here. Let's do this quickly. No border. Put it down here. And then we'll fix this. Okay. And the last one here on August 31st, we had a credit to cash for $675, so we will put that there. Now, cash being an asset has a normal balance in the debit. Remember, our assets, dividends and capital withdrawals, and expenses have normal balance in the debit, where liabilities, capital contributions, and revenues have normal balances on the credits. So for cash, we'll add up our debits and subtract our credits. So in debits, we have $98.31. In credits, we have $29.80, $35, $36.55. And as we subtract those, we get what? $61.56, I think. Let me, I'll pull a calculator up here, and check real quick. 6,500 plus 33.31 minus 2,100 minus 880 minus 675. 6176, 880, 675, 6176, okay. All right, so that's how we use our T accounts here. Next, we'll go to office supplies, and we'll look down through and see, oh, on August 5th, we had a debit for $880. It's the only one we had. So we'll debit the T account. Since we don't have any credits to adjust for, we can just bring that down. Prepaid insurance on August 2nd, that was $2,100. Again, that's the only transaction we have regarding that, so we can bring that down. Photography equipment, that was $33,500 on August 1st in the debit. Nothing else there for that, so we can bring that down. Common stock, that was up here. That was $40,000 on the credit. Nothing else with common stock, so we can just bring that down to our total there. Photography fees earned, let's see, we have a credit on that of $33.31. So, and that's all, that's the only revenue we had here. So we can bring that down. And then utilities expense, we have a debit of $675. So we will bring this down. And these are our T accounts. So we've done the T accounts here. And now they're asking us to prepare the August 31st trial balance. So we'll do that. We'll do that over here quickly. And this, what's the name of this company again? Pose for Pics. So we've got that. Oops, we will have, do that. We'll have trial balance here. Trial balance. And then we will get our date on here, and this is August 31st. Okay. So now all we have to do really is put our accounts in, and we just have to, really, the simple thing is we can just go by what we have here on our T accounts. That's the simple thing of it. So we'll have accounts here, and then we should have, we'll put a debit and credit here, so we know. We will make this nice and pretty. Put a little bottom border on it there. All right, so our first account we have is cash. And we know from our T accounts the balance in our cash is a balance of $6,176. Oops, let's not put it there. On the credit side, or debit side, I'm sorry, debit side. So 6176. Our next account, office supplies. And this has a balance of $880. Next we have prepaid insurance, and this is $2,100. Then we have photography, APHY, equipment, for debit of $33.5. Then we have common stock, a credit of $40,000. And photography fees earned. That's a credit of $33.31. And then utilities expense. And we have a debit here of $675. Now, this is our trial balance. What we do is at the bottom here, we'll put some little underlines, and then we'll put in for totals. Oops, where'd you go? There. And what we want to do is just sum these columns. So basically, we'll auto sum down here, and we get 43.31, and we'll do the same thing in this column, and we get 43.31. So if our debits and credits align, yeah, we're good. We're on balance. All right. So here's how we journalize, go to T accounts, and do a trial balance. Now the next problem was problem P. I think it's just 25A. There it is. I don't want to get in the way of everything here. Let's try and make this a little smaller. There we go. We're going to be looking at net income and such here from equity analysis. We'll be doing a balance sheet and so on and so forth. So we've got information here from this company, Nettle Distribution. And the first thing we want to do is prepare balance sheets for both December 31st, 2018 and 2019. And it says here we only have to report total equity on the balance sheet. And remember, total equity is the difference between assets and liabilities. So for 2018, for both balance sheets, all we have to do is plug in the numbers here. So we have cash, and I need to this. So cash in 2018 we had 64,300, and you can see my balance sheet here is dated for that. We have accounts receivable. I'm going to abbreviate this with A/R, and we have 26,240 there. We have office supplies. Oops, wrong cell. Office supplies in the amount of $31.60. We have office equipment in the amount of $44,000. And we have trucks in the amount of $148,000. Now, if we add all these up, summate here, what we have in this column, we will get $285,700. Now, for our liabilities, we have accounts payable here, and I'm going to bring out the A/P, and that is $3,500. And then down in equity, we have, well, we don't know. We don't have anything. And this is what they're telling us. Only total equity on balance sheet. Remember, total equity equals the difference between assets and liabilities. So basically, we just have to put total equity in here. I'll put it down here. Total equity. And remember, assets are equal to liabilities plus equity. So basically, if we just subtract liabilities from assets, we get what our equity is. So if we take the 3,500, 285.7 minus 3,500 is 282.2. That is our equity. So our total liabilities and equity are equal to liabilities plus, oh no, equity. Oh, let's see, what is that? Q9. So 285.7, we balance, we're good. Now let's do the next year's, 2019. We have cash in the amount of 15,640. We have accounts receivable for 19,1. We have office supplies for 1960. Office equipment for 44,000. Trucks again for 157. Oh, we got some more. We've got building and land also, so we'll have to put some more cells in here. Oops, let's do it this way. Actually, let's do it this way. That way I don't have to do that. Down, 1, 2. And we'll leave our trucks at the bottom there at the order we have in our assets here on the balance sheet, although we'll move back up there. Okay. And we'll get our little underline out. No border. Okay, so we had trucks. Now we have a building. So this year we got a building. And the building is at 80,000. And we also have some land now. And our land is at 60,000. So if we look at this, and we're going to end up totaling everything again, because again, we want to know the total of the assets. Total of our assets is going to be 377,700. Okay, so now let's look at liabilities that we have here for 2019. We have accounts payable. That's a lot larger now. AP, accounts payable, and that is 33,500. And now we have also a note payable. So that's a liability as well. And I'll just abbreviate that as well with NP. And that's at 40,000. All right. So since we have a little extra here, we're going to do a quick change to things in our format real quick here. So here we'll have total liability. Since we have more than one, we will put them here. We will sum them up. And we have $73,500 in total liabilities. So now let's look at our equity. And remember, when we're looking at the equity, like they said, they don't give us anything. We're just looking at using our accounting equation to solve this. So we'll have equity, and here we'll put it down here. We have total equity, EQITY, and our total equity again is the difference between our liabilities and assets. So if we take 377.7 and subtract 73.5, this minus this, we should have 304,200. Total liabilities and equity are just what they say, equal to total liabilities plus total equity, which is what is it, Q23? Hopefully. Yep. So assets and liabilities and equity all total. So here we're good on this balance sheet. All right. Now, the second part says compute net income for 2019 by comparing total equity amounts for these 2 years and using the following information. During 2019, the owner invested $35,000 additional cash in the business in exchange for common stock, and the company paid a $19,000 cash dividend. So really, we're looking at this, and we're going to say, okay, the owner put $35,000 in. We know we have that, $35,000. We have to add net income. We don't know what this is. This is our big question mark. What do we got here? We know dividends that were paid. We paid $19,000 in dividends. I'm going to put that in as a negative sign right now. And now if we look at this, the equity increase. Well, how much did our equity increase from one year to the next? Well, if we look at equity in 2018, it was $282,200. 2019, it was $304,200, which means our equity increased by $22,000. Or we'll do it like this. We'll say it's equal to the equity here minus the equity here. So if we think about it, we take the money that's in for capital, add our net income, subtract dividends, and we get what we have as our change to the equity. So in this case, basically, we're taking the 35,000, we subtract 19, that gives us 16,000. Well, what do we have to do to 16,000 to make it equal to 22? We'd have to add 6,000. So we're seeing here, 6,000 is the net income for 2019. Now, last part here says compute the year-end 2019 year-end debt ratio. And we knew our debt ratio is equal to total debt. So this is 2019, so we're looking at total liabilities. So it would equal our total liabilities here. And we're looking at that divided by total assets. So if we look at this, total assets are 377.7. So in this case, our debt ratio is equal to this divided by this, which is 0.1945. If we change this, let me get back here to a percentage, give it a decimal place, we're looking at 19.5% is our debt ratio. Okay, so this is how we look at balance sheets. If we have our equity and we know our other information regarding capital and dividends, we can determine net income. Now, the last couple problem or two I have here is exercise 216 and 217, again from the end of the chapter 2. And in this one we have Carmen Camry operates a consulting firm called Help Today, which began operations on August 1st. On August 31st, company's records show the following selected accounts and amounts for the month of August. Use this information to prepare an August income statement for the business. Okay, well, basically this is really looks like a trial balance here. So income statement, we're just looking at revenues and expenses. You know, that's all we look at when we look at income statements. So if we look down through this list here for what we would look at in regards to, you know, income, well, we're going to see what type of revenue did we have. That's what I should have said, revenue, not income. Consulting fees earned. There's our revenue. So we'll have consulting fees earned. And in this case, when we're looking at the consulting fees that we have, it's $27,000. Okay. So now we want to look at our expenses, and because on a balance sheet, that's what we have, revenues and expenses. So our expenses are down here at the bottom. We have rent expense. Just put all these accounts in. Salaries expense. Telephone. Telephone expense and miscellaneous expense. So these are our expenses, and now we can put our amounts in. So we had $95.50 for rent. Salaries was $5,600. Telephone is $860, and miscellaneous is $520. So we'll add these here, and what we get is total expenses, which we should put that in here. Total expenses. Total expenses of $16,530. So now our net income is just revenue minus expenses. So revenue minus expenses, what is that? 11. And we see net income of $10,407. Okay. So next, what we want to do is 217 is preparing a statement of retained earnings. Okay. So the easy information per August statement of retained earnings for Help Today. The retained earnings account balance on August 1st was 0. Net income for August is 10,470. We just calculated that. So we start retained earnings statement with what we had to begin with. And retained earnings as of August 1st were zero. We had no retained earnings. Now, what we need to do with retained earnings, we're going to add in our net income. So we'll add net income from the period, which was 10,470. And we'll add these two below. Okay. Now, the other thing we have to worry about here are dividends, and we paid $6,000 in dividends. So we've added the net income. Now we need to add net income less dividends, because remember, dividends are paid out. So our dividends were what, 6,000? Oops. So our retained earnings for the month are equal to what we had here with what we started with plus our net income minus our dividends. So $4,470 is what we have now as a balance in our retained earnings account. Now the balance sheet. Okay, well, if we look at the balance sheet, we have our balance sheet accounts here towards the top of a trial balance, and the first one we have is cash. And then we have accounts receivable and office supplies. Accounts receivable, office supplies. Land and office equipment. Let's see, wait a minute. 1, 2, 3. Land and office equipment are the last two. Okay. Office equipment. Oops. All right. So here are our assets as they're listed on that trial balance. And the balance for cash, we have $25,360. For accounts receivable, $22,360. For office supplies, $52,50. For land, $44,000. And for office equipment, $20,000. Okay, so now we'll total for our assets, and our assets total $116,970. So now let's look at liabilities. Now for our liabilities, we have accounts payable, $10,500. 10,500. And in equity, we have common stock. Common stock is all we have there. See. And the balance on our common stock is $102,000. And then the other thing we have in equity is our retained earnings. And our retained earnings, we calculated it above, is equal to the 4470. So basically our total equity is equal to this plus this. And if we add everything up here now, total liabilities and equity are equal to the liabilities that we just had that, plus our total equity, which is 34. So total liabilities and equity are $116,970. Total assets are $116,970. So we've got our balance sheet done. So this is how we do income statement, statement of retained earnings, and balance sheet. So this is it for the little sample problems this week. These kind of relate to what your homework is about and refer back to the stuff from the chapter this week. So if you have any questions, you're welcome. Call, text, email. Other than that, I will be in touch later. Have a good day. Bye.